What's up, guys? Welcome back. A video that is a long time coming. With all the options videos I've ever done, people ask me all the time, like, if I have a go-to, what's my standard? What options am I trading right now? What is my favorite strategies out of all of the strategies there are? So in this video, I want to go through my favorite strategies. I'm not going to talk about them in depth as far as what they are and how to do them. I'll leave all the links from all those videos and even a playlist down in the comments below. But I want to give my personal perspective. I get questions on personal things like, what are these options like good for? Like, what type of market, what type of investors are they good to? How should I choose them? How to open them? How do I maintain them? What Greeks do I personally look at? So I want to go through each of those, the things like that are going on in my head when I'm thinking about these option strategies. And frankly, this is going to go from the beginner, somebody that's just learning options right now, all the way up to someone like me that's been doing it for years. But we're going to start with pretty much where I started, and that was with the wheel strategy. Now, the wheel strategy involves writing or selling covered calls and also puts, oftentimes, most often in my case, cash secure puts, but we'll talk about naked puts as well at the end. And these are going to be done one at a time in sequential order. So you'll either start with a covered call, and then you go to a put, or you start with a put and you go to a covered call. Now, the goal when we are selling options, both calls and puts, are to collect premiums. So we are going to write out a contract. That's essentially what we're selling. We're selling the contract. We are going to collect premium from a counterparty. They will be the buyer. So they buy the contract that we write and they give us premium, or the value of that option that we take. We put in our pocket, it goes in our buying power, and it's ours right away. Now, to write these options, you are going to need some collateral, whether you are writing the covered call or the cash secure put side. So it's all about premium collecting, the value of that option, and the collateral that you're going to use to be able to write that contract, right? Whenever you're selling something, you are going to need that something or something tangible to it for that collateral. So why is it one of my favorite strategies and the ones I started out with? The thing that I like the most about it, it has very defined, controllable risks, which makes it really good for beginners, okay? So you get to control this. Now, the downside is that there is a pretty capped profit, right? Your profit is going to be the premium that you collect. Well, when you buy options, you have an infinite amount of profit. So there are more like YOLOer types that don't really like writing options because, with that defined and controllable risk comes a lower amount of profit, not chance of profit, just an amount of total profit that you can gain. The types of stocks that I'm going to like, or the type of market that I'm going to like for this particular strategy, is steady, consistency, either up or down. Nothing crazy, nice and constant movement, either up or constant movement down. That's going to depend on whether we're doing the covered call or the cash secure put side. Let's start with the covered call and kind of like what I'm thinking about when I make my covered calls. So the covered call is when you use 100 shares of a stock that you own as collateral. So you have 100 shares of a stock, you are going to write an option against those 100 shares. Now, there is a more advanced strategy where you can use a long call as the collateral for that covered call, and we'll get to that in a few minutes. But more standard, you want to be trying to get to 100 shares of a stock. Once you get to 100 shares of a stock, then you could start thinking about the covered call. And it's really where I began. And I could have started with the cash secure put side, and this is a question I get all the time, like, where should you start? I like starting with the covered call first because it takes some time to build up to 100 shares. And during that time, that was my time for education. It motivated for me to keep investing and build up to 100 shares, but it also didn't rush me into anything impulsively like the cash secure put could do. So I like to start with the covered call, build up 100 shares, and then you're ready. Now, this company should be a company that you want to hold long-term. The wheel is a long-term hold type of strategy. So it can't be like a stock that you're just like a penny stock, you're trying to YOLO. You could do it. I personally, these are going to be my long-term holds. I love to do this with blue chip dividend stocks, right? They go up kind of slow, if anything, nice and flat. They don't moon. There's not a lot of volatility. I love blue chip dividend stocks for doing the wheel strategy, as well as, besides that constant, consistent, predictable growth that they have, it's also great to collect some dividends here and there as well as like a little bit of added bonus. And I think in its nature, the covered call was really designed to like hedge against a position that we had that we thought was going to be going up, but now it started to maybe trade flat or trade downwards. So in this short-term flat or downward period, we can hedge against that loss in share price and capital gain by collecting some money in premium by selling calls against it. So I think that's like primarily where the covered call was created. But now that people know about it, inside the Discord, we got 500 or so people that are writing covered calls. People are just doing it just to make passive income and generate some extra money from those premiums. So it doesn't really matter which of the two you are, whether you're holding a stock and now it's starting to dip and you're like, oh man, I'm losing some capital gain, but I'm going to make that up by selling premium. Or I just have 100 shares of a stock. I'm going to write my strike pretty above my basis and I'm just going to collect premiums over and over again. That really is up to you. Now, before we get into expirations and deltas and the Greeks and things like that, I want to reiterate, you are going to get assigned eventually, okay? You must assume in every single options trade that you are going to get assigned. There's ways we can protect against it, but just know you are going to get assigned on your covered call eventually, and you are going to have to sell those 100 shares at the strike price that you chose. First, let's talk about expiration. I like expirations pretty much weekly. If I can do weeklies on them, 14 days is really going to be the max. And the reason for that is I want theta on my side. If you don't know what theta is, I made a video about the Greeks. I will also link that down in the description below. Watch the Greeks, understand them, and know what theta does, especially in those last 14 days of an options contract. It just crushes down the value of that, which is great because if we want to close, we'll be able to buy it back at a much smaller price than we sold it for. So for me personally, I am going 1 week, maybe 2 weeks. Now, there are some stocks with low volume. They only do monthlies. And people say, oh man, I hate that it's a monthly. Remember, once a month, they're weeklies. Or once a month, they're 14 days. So maybe you have like a window where you have a monthly stock. I know Realty Income comes off the top of my head. You know, they only sell monthlies. Well, wait until there's 2 weeks left until expiration. Boom, now it's a 14-day. Or wait till it's 1 week. Now it's a weekly. But it really depends. You want to be pretty close to expiration, but still give some time and some things to happen in your favor. So 1 week, 14 days is just my general rule of thumb. For my strike price, first and foremost, guys, you must be above your cost basis. Whatever your average cost was per share on those 100 shares that you own, your strike price must be above that if you want to sell at a profit. Right? If your basis is $20 and you make a strike at $9 and now you're assigned, you just lost $100. So please, first and foremost, make sure that your strike price is above your average cost. The next thing that I'm looking for is I'm going to look at the delta. Once again, you can kind of look and see what delta means. I use it as a general guideline for my percentage of success. Now that percentage of success goes on the buyer side. So I'm going to be looking at a delta of 0.3 or lower. At a delta of 0.3, that pretty much means that the buyer has a 30% chance of success with their option. They're the counterparty. So that gives us roughly a 70% chance of success. Delta 0.2 gives us roughly an 80% chance of success. I usually start at 0.3 and then I go lower than that and see where I'm at in accordance with my basis. If I'm way above my basis, like my basis is 19 and I've been doing this for a while and my share price is now 30, I might play right at the money, collect more premium, because if I get assigned, I'm going to make a ton of money on the capital gain of that assignment. I very rarely, if ever, ride out a covered call until expiration. I buy to close. As soon as I set that option, I set a limit buy to close order for 75% of the total premium that I collected. For math purposes, let's make this easy. If I received $100 in credit, as soon as that option has a value of $25 and I am going to be guaranteed $75 in my pocket, I'm going to buy to close for that $25 value. I'm going to give some of that premium back of the $100 I initially collected. I'm going to put $75 in my pocket and I'm going to walk away from that deal, and I'm either going to roll up and out, definitely going to roll out and maybe up or down depending on what the share price has done. But from my experience, waiting till expiration for that last 25%, too many things can happen in those last couple of days to expiration, especially with liquidity, and it might get hard to get out. And I've seen people get screwed trying to squeak out a few more dollars in premium just to get to expiration. For me, if I get 75%, I'm in. When we were writing covered calls, when we are selling options, we want to get in, we want to get that premium, and we want to get the hell out. So in the chance that I do get assigned, because it is going to happen, well, now I have money from selling those 100 shares. I'm going to use that money and I'm going to sell a put and try and buy those 100 shares back at a strike price that I want. So let's talk about the cash secure put real quick. Now, the only real difference is now we are pretty much saying that we will buy 100 shares at a given strike price as opposed to selling 100 shares at a given strike price. The other thing is now we want our share price to stay above our strike to expire worthless. We're in a covered call. We want our share price to stay below our strike to finish off at expiration being worthless. So the expiration, the strike, the deltas, and the buy to close criteria that I use for the covered call is essentially the same. The real difference only is that strike, right? For the covered call, we want our strike price to be above our basis. With a covered call, we want our strike price to be a price that we'd be comfortable buying 100 shares, right? So with the wheel, like if I get assigned at $25, I'm going to try and do a cash secure put at $25, right? Because I kind of want those two strikes to wash themselves out. So you kind of got to play with that. When you get assigned, you see it's a lot easier with the covered call sign because when you buy them, now you have a set basis. It's a little bit easier to choose your strike, which is another reason why I like to start with the covered call because there's a more defined cost basis where if you are trying to sell cash secure puts and it goes worthless, the price just went up. Now you have to keep raising up your strike. And now, a couple weeks later, you might be paying more to get those 100 shares at assignment that you previously wanted to before. So my general advice, once again, I like to build up to 100 shares and start with the covered call. Now, when we say cash secure put, that means that like in the covered call, we had 100 shares of collateral. In a cash secure put, we have that money in our buying power that our brokerage is going to hold as collateral. So if there's a $10 strike, they're going to hold $1,000, the money you need to buy those 100 shares as collateral. If you have a margin account with your broker, most brokerages will allow you to use the margin for collateral. And the beautiful thing is here, most of them will not charge you interest because you've not bought any securities. So let's say you have $1,000 in margin, you can sell a put, use that $1,000 as the collateral, not have to pay the broker interest unless you get assigned. But then when you get assigned, you can either A, sell those shares off to pay back the margin, or you can just pay the interest or deposit money. You have a couple different options. And I'm not a fan of margin. I'm really not. And I've said I do not do naked puts, but the more I thought about it, if I'm not paying interest on it, and I know that I can sell the shares right back and get most of that money back to pay the mortgage margin, or if I know that I have the money in the bank or the buying power, I'm not really opposed to using margin only as collateral for selling puts. So that strategy and this strategy has helped me have pretty much I'm almost at 150% returns over the last 365 days, starting with a $5,000 portfolio. I started with a $5,000 portfolio a little over a year ago, and now it's at about $11,000. So just using the wheel and collecting premiums over the course of the year and this strategy right here. The next one is called the Poor Man's Covered Call. Now, I have a ton of options videos here on YouTube, but my Poor Man's Covered Call video with my face going like this, that one, it has a ton. It's my most viewed video, and I like it should be because the Poor Man Covered Call is awesome. If you don't know what the Poor Man Covered Call is, I will link that video. If you've been around my channel for a while, you've probably seen that face. But essentially, all it really is, it is a diagonal debit spread, right? So the technical name is not the Poor Man's Covered Call. It's really just a spread. And I'm not really a fan of vertical spreads. I really do not trade them. I've gotten burned on them trying to get into them. I know so many people have had problems with spreads. And unlike the wheel strategy, when you get assigned, you don't get to get shares or sell shares. You just lose money. So I don't really like vertical spreads, but this diagonal spread, I love it. Even at a debit, I still love it. So now what this involves is buying a long call, buying a call far out in expiration, a LEAPS, a long-term equity anticipation security that is going to be deep in the money. And we'll talk about how far deep in the money in just a second. You are now buying an option, so you are going to pay premium to the seller of an option, right? That's going to be the debit. So this is sometimes not, scares beginners as well because now you're paying, you're not collecting premium. Once you do that, now you can sell a call against it. Now, for most brokerages, you are going to need level 3 options. If you're in Robinhood and you're trying to do the Poor Man's Covered Call and they're telling you don't have enough shares as collateral, you need level 3 options trading. Now, once you have this, you have to be able to do spreads. I don't think you could do this with Webull. You definitely can't do this with M1 Finance. So, if you got to get down with Robinhood, I'll leave a link down in the description below for that. But all you're doing is you are going to buy an option long, and then you are going to sell a covered call against it. And that's going to collect premium, as we just discussed. It's still going to be a net debit situation because the premium you're going to pay for that long call is going to be more than the premium you collect. But as we see, when we start collect, you are going to pretty much offset the amount of premium that you paid for the long call, as well as hopefully profiting off that option, which kind of gives you like a double chance to win. Some of my long calls that have not really even gone up that much, traded flat, I broke even on because of the amount of covered calls I was able to sell against it. I was able to sell covered calls, collect premium, and then wash out the premium I paid. So when I got to expiration on my long call, even though I lost, it expired worthless and I lost that premium, I really broke even because of all the calls that I sold against it over time. Now, what types of stocks am I looking for this? I'm looking for stocks with steady, long-term, pretty much a track record, predictable growth. I don't want this thing trading flat. I definitely don't want it trading down, but I also don't want it super volatile and shooting up to the moon. I kind of want it to just make it steady, regular, nice, perfect upward trend over a long period of time. The next thing I'm going to look for is that stock to be in a period in its historical implied volatility. I want that to be low, right? Implied volatility is relative only to itself over time. I want the implied volatility on that leaps to be low. And I want that because when we buy options, we want the value of the options to increase, right? So if you buy at a low volatility, it's most likely going to come back to its mean. It's going to come up. It's going to raise an implied volatility. And we know due to extrinsic value, that's going to raise the premium of that option and we're going to win. If we go in and we start buying leaps at a high point in their volatility, we are going to lose extrinsic value as it comes down to the mean, and that's no good for us. So we want long, steady growers in a period of low implied volatility according to its historical average. Now, I also want these stocks to have pretty high liquidity, high volume, right? Because now we're trading spreads. There's two options in play. We want that high liquidity, a lot of volume, so we can get in and out if we need to. And frankly, the ones that I really love for this are going to be blue chip, like the dividend growth stocks. I don't want dividend stocks because they trade pretty flat. That's not really good. And I don't want like the heavy growth spec stocks because the volatility is so high and they shoot up, and selling the calls against that can get really, really messy. Specs are great for, if you're going to be just selling the long call. But as far as the poor man's covered call, like I said, nice, like Apple, for example, is one that I like. If you want to see all the things that I do, I post all of my trades in real time when I open, when I close, what I'm thinking about inside my Discord. I will leave a link down in the description for that. You could check that out and get in the conversation with all 500 of us doing this. But like an Apple is kind of like a pretty good player, something that I think about when I look at the poor man's covered call. So just make sure it's a grower and make sure that implied volatility is there, because if you have a poor man's covered call with a flat stock that is, losing implied volatility, it's gonna make you angry. Let's talk about expiration. I'm going to go at least a year out, personal preference. I've tried 9 months. What I found out is 9 months comes up quick, right? Especially if you're going to be doing this with, stocks that only have monthlies. That gives you 9 chances to collect premiums. So I like to go a year out, right? You could do 9, you could do whatever you want. You could do a month. I don't really care. But for me, I found the most success by going out at least a year. I'm going to go deep in the money, and how I determine in the money is, once again, I look at delta. I used to do like 0.7, but actually now that I've been doing it a little bit longer and like I'm a little bit more boomer and I kind of want to like not have to manage it as much, I've lowered that down. I'm pretty much at 0.8. Anywhere, if I get to like 0.7, I'll start to look. If it's something that I really, really want, I might jump into it, but I'm really going to go with 0.8. And there's really 2 reasons I do that. We know that delta gives you kind of a rule of thumb in like how many shares that is. So if you have a 0.75 delta, that's like owning 75 shares of that particular stock. But it also allows, the break even on my short call. If I were to get assigned, it makes it a lot easier to achieve. I'll talk about that break even in just a second and why I want to be far below the strike price, deep in the money when I make this long call. Now for the short call, I have the same expiration rules. I'm going to do kind of weeklies, but the strike is a lot different, right? Because there's no real cost basis. There is that break even price. Guys, a break even upon assignment, if that short call gets assigned, you need to remember that if you take the differences in the strikes minus the premium that you paid and then add any premiums you collected, that is your cost basis. let's say, for example, you bought that long call at a strike of $10. Now you want to sell a covered call at $11, right? That is a spread of 1. The contract's 100 shares. So that's a $100 play there if you get assigned, right? But now that $100 play, it really means, in relation to how much premium you paid for a long call. If you paid $50 for the long call, okay, you just made $50. You win. So that strike was okay. But if you paid $200, well, now you just lost $100. So you have to remember, never, ever, ever sell that short call at a difference in strikes that is less than the premium you paid. It's an amazing rule of thumb. Just go by that to start with where your short call could be. And at assignment, you literally cannot lose any money. If you gamble and you bring your strikes in nice and close, you will get assigned and it will piss you off and it will make you angry and you will regret it. So the further deep in the money we can go, the closer, right, to the share price we can go with our short call and make more premium. If you're not deep in the money, you are shrinking that difference in strikes, and then you have to go further out with your short call, which is going to collect you less premium. So go deep in the money and pay more premium, and then collect it back shorter, closer to the money as you're selling throughout the year. Because assignment sucks, my deltas are going to be even smaller than 0.3. I'm going to go to 0.2. We want to avoid assignment in this at all costs. In the wheel strategy, I have no problem getting assigned because I'm just going to sell puts. But now we're going to lose money in our long call. It's going to be a mess. We do not want to get assigned, so I'm going to make my delta like 0.2 or less. My buy to close percentage is also going to be different. Instead of that 70-75 for the standard covered call, I'm going 40 to 45. Why? Assignment sucks. I'm not risking it for another 30%. I can roll it up and out if I need to. I want to get in and get out because I don't own the shares. I'm using the stock. I'm using my long calls collateral. So I want to get in and out. So that's also going to change. Another thing I would do that I would never do in the wheel strategy is in a poor man's covered call, I will buy to close that short leg at a loss if I need to protect and hedge against my long call. So if the value of that option goes up, I'm pretty close to expiration. I do not want to get assigned. I am going to sell that option even at a loss because as the price goes up, I'm still making more money in intrinsic value on my long call than I'm losing in paying some premium back. Happens very rarely, but it is much better to buy to close and lose a little bit of money. Like if it moons and goes way above, yeah, it might not be worth it. But if we're dancing around at expiration and it goes 50 cents or a little bit above, yeah, I'm going to pay that. I'm going to protect my leaps. I'm going to make the money up in the future when I'm selling more calls against it. Question I get asked a ton is what do I do with my long call? I'm going to sell to close that starting in about 60 days. I'm going to look and I'm going to get that done before 45 days. Once again, that's when theta's going to ramp up. Theta hurts, when we buy options. It hurts the premium. We do not want that. So at about 60 days, I'm going to look to sell to close, wrap it up, and start over again. If you want, you can, just like any other spread, you can close these at the exact same time. You cannot close the leaps first and leave the covered call open because you need that leaps to have collateral for the covered call. But yeah, you can close them at the same time. Oftentimes, just for liquidity and things like that, I'm going to try and close the covered call first, and then I'm going to close the leaps. And I do get asked what happens on assignment. It depends on your broker, guys. It really, really depends. The options that you're going to see or the things that are going to happen if that short call were to get assigned. What's going to happen? First thing, your broker is most likely going to exercise, right? Not sell to close. They're going to exercise your long call, and that's going to be that. It's going to use that long call when you exercise that to do that. Another situation, if you have margin, okay, they're going to use the margin to buy 100 shares to cover that covered call and leave your leaps open. I've heard of that happening. The other thing that I've heard happening is that they will close that, assign it, give you like a little margin buffer, give you a day or two to sell to close to clear up everything. But there's going to have to be some sort of exchange of you getting the 100 shares over here to be able to sell them over there. That's really it. I've had them assigned, and all the times that I've had them assigned, they are automatically, the leaps is automatically exercised, and it's cleared up like that. It usually gets settled by the weekend. I'll leave the options playlist up here, guys. You can check that out. Thank you so much for watching. If you did get any value from this video, please give it a thumbs up. If you're new to the channel, consider subscribing for more content just like this one. Until I see you on the next one, stay positive, work really, really hard. Always, please be kind to other people. Hope you have yourself an amazing day and an even better tomorrow.